This is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, a flurry of tech unicorns charging to the public markets. Wework getting the most attention. We're going to take a look at the inner workings of CEO Adam Neumann's company and his complex and controversial business relationships. Plus, content kings CBS and Viacom finally ink an $11.7 billion merger deal. We'll talk to Viacom CEO Bob Bakish about content synergies and the road ahead. And what slowing economy? Chinese online retailer Alibaba defies China's slowdown amidst a trade war, with sales surpassing expectations. First to our top story, it was a big week for coming tech IPOs, with both Wework and Cloudflare filing to go public. The web security company Cloudflare has been in the news recently, given its relationship with the controversial online message board 8chan. 3 alleged gunmen posted manifestos on 8chan before 3 separate mass shootings in the United States. Cloudflare stopped providing services to 8chan after the latest shooting in El Paso, Texas, left some 24 dead, largely taking the messaging platform offline. So, is now the right time to go public for Cloudflare? I discussed with Bloomberg's Liana Baker and Will Turton.
So like many other tech IPOs, especially in software, it is not profitable. It has a pretty good growth rate, though. So it's really trying to look at a competitor, Fastly, and follow in its footsteps. Fastly went public earlier this year and is doing okay. There have been some sources of mine who were asking me why Cloudflare took this long, though, to get to this point and have their filing. They had been preparing since the fall of last year for public offering.
Right. Cloudflare is a company, a name that we've heard often in conversations about companies that could go public soon, and it hasn't happened until this filing now. William, tell us a little bit more about what exactly Cloudflare does. I mean, in the case of a company like 8chan, they basically protected 8chan from being taken down in denial of service attacks.
Right. So one of Cloudflare's most popular and well-known products is what's called DDoS prevention service. It essentially protects a website from a denial of service attack. So anyone looking to attack the website and take it offline. And they offer this service to tons of websites on the internet. They think of themselves as a utility. And when you have this service, it's the most effective, or one of the most effective ways to protect your website from attacks like this.
Right, and this is where 8chan comes up, because Cloudflare, time and again, did not cut off 8chan. The site was obviously still operational until just days ago after that shooting in El Paso, Texas. Liana, talk to us a little bit about what Cloudflare says about 8chan and how investors might take that.
It's listed as a risk in the filing, and this has really gotten a lot of attention because it's buzzy, it's relevant in the headlines. But I think that Cloudflare was really aiming in its filing today to just show the world how its financials are doing and what its prospects are. So I think it did a good job of putting out there that this is a solid company that serves the backbone of the internet. And there's been pent-up demand among investors for these sorts of companies to hit the market. A few weeks ago, Medallia went public. CrowdStrike also has a really good valuation a couple months after its IPO. So I would say Cloudflare today really is just trying to associate itself with some of these successful software IPOs from earlier this year.
That said, Cloudflare sort of only made news when they've made bad news, under criticism that it's helped keep some of these websites afloat. If you go back to 2017 and what happened in Charlottesville, at the time, Cloudflare was under fire for helping support a neo-Nazi website, the Daily Stormer, and it was only after much criticism that they finally essentially took that website down by cutting off service to it. I spoke with the CEO, Matthew Prince, at the time and talked to him about their general policy of, trying to remain neutral when it comes to content online and the websites that they service. Take a listen to what he said to me then.
We turn to the experts in terrorism and illegal content, which is law enforcement, legislators, regulators, and we say, here is this content, what would you like us to do? That to me feels like the principle of due process, that they are actually politically enshrined organizations who can make these decisions, as opposed to these decisions being made based on what the political whims of me or Mark Zuckerberg or Jeff Bezos.
Now, when it came to 8chan more recently, it was, several hours after that shooting in El Paso that Cloudflare kind of finally said, all right, we're cutting them off now as well. And in a statement at the time, Prince said they have proven themselves to be lawless and that lawlessness has caused multiple tragic deaths, even if 8chan may not have violated the letter of the law in refusing to moderate their hate-filled community. They've created an environment that revels in violating its spirit. Will, expand on the sort of context here. It's very complicated issues. We're seeing, companies as big as Facebook and Google grapple with what to leave up and what to take down on their platform. And for Cloudflare, it's a slightly different story.
So Cloudflare's in a really difficult position here because they don't want to make content decisions, as you saw in that interview. Like I said earlier, Cloudflare kind of thinks of itself as a utility. The product is so good and it's hard to find other comparable products. So when you don't have Cloudflare's DDoS protection, it might be really difficult to stay online. So what that means is Cloudflare basically can decide who gets to be on the internet. They don't want to make those decisions. And as you've seen, they've only made that decision twice in removing the Daily Stormer and 8chan. So it's a really difficult position, and when you do things like remove 8chan and remove the Daily Stormer, then you give people material to say, well, why don't you remove this website or that website or whatever other website on the internet has vile content on it. So I don't think this is a business Cloudflare wants to be in. They don't want to be deciding what's on the internet and what's not.
That was Bloomberg's Liana Baker and Will Turton. Wework also officially filed for its IPO this week, expected to raise around $3.5 billion. That would make it this year's second largest IPO behind Uber. Wework revealed a loss of $690 million in the first 6 months of the year and almost $3 billion lost in the last 3 years, along with some, let's say, unique business dealings by the CEO. Bloomberg Tech's Ellen Hewitt had all the details.
Anyone who's been following Wework closely knows that they've been giving out select financial information quarterly for the last year or so. So we already knew that, for example, in 2018, Wework lost close to $2 billion while making a revenue of around 1.8. But there were some surprises. I think we got more details about some of the loans and complicated financial structures that go on between the founder, Adam Neumann, he's also the CEO, and the company. We had gotten some knowledge about this before. He has famously been a landlord in a few properties that Wework has rented, but we got some new information about loans that the company had made him, the succession plan that would happen if he were no longer able to serve as the CEO, that kind of thing.
So our colleague Shira Ovide called it the office subleasing company on steroids with a complicated corporate structure. Now, on top of this, they're offering 3 classes of stock, one with 20 times voting power as another, which even takes a step further than what Mark Zuckerberg and the founders of Google have done, right?
Right. There's actually 3 classes, and 2 of them have 20 votes per share, and the one, Class A, has 1 vote per share, as you would expect. So, right, that's a great consolidation of power. It's all, or not all, but largely in the hands of Adam Neumann. He has a lot of voting control over the company, and that's kind of by design. People who support this structure think that Adam has the right vision, the boldness, and the leadership to take Wework even farther than it has been. And obviously, for some of the people, they're going to look at that and raise their eyebrows, thinking that might be too much.
Now, the other thing that's interesting is they laid out exactly how many of the buildings are fairly new. 30% of their locations are mature, as they say. 70% are 2 years or younger.
Yeah.
So the vast majority of their space is incredibly new.
And they've actually changed the definition of that metric of a mature location. It used to be 18 months. They've expanded it to 24 months. And even with that expansion, you're right, it's only 30% of their office locations have been open for more than 2 years. They look at that as pointing to
high growth now.
Right, exactly. Like, look how fast we're growing. But it's also interesting because a lot of the most stable unit economics that they like to highlight are focused only on mature locations. They say these are where we no longer have to rely that much on marketing to fill the buildings. But when you start to realize that's only 30% of their portfolio, it starts to raise some questions about how sustainable their growth is and how easy it would be for them to get to profitability if they stopped growing.
Right, and they say in their risk factors they may never be profitable, which is similar to what we heard with Uber and Lyft. How are investors feeling about this company? Are they excited?
I mean, I certainly see a lot of activity on Twitter on both sides. Some people think that the growth is really exciting, and other people can't wait for it to go public so that they can short it, right? I think it's just going to be a divisive stock. We're going to see that the price is going to be decided soon by the public markets, and I think a lot of people are looking to see whether it's going to meet that $47 billion private valuation.
So how quickly do we expect them to get to market? When does the roadshow launch and all that?
It could happen very soon. So sometime in the next few weeks, we expect and have reported that we expect a September IPO, and that's just around the corner.
That was Bloomberg Tech's Ellen Hewitt. Coming up, thumbs up, Sherry Redstone cements her status as the most powerful woman in U.S. media, with CBS agreeing to merge with Viacom in a long-awaited $11.7 billion deal. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. In long-awaited deal news, CBS agreed to merge with Viacom in an $11.7 billion transaction. The all-stock deal unites the most-watched U.S. broadcast network with the parent of Paramount Pictures and cable channels like MTV and Nickelodeon. It followed a marathon negotiating session this week as the two sides hashed out a price for the long-awaited merger. I got details from Bloomberg's Lucas Shaw.
I think they finally realized that after 2-3 years of going back and forth, that whatever misgivings they might have had about what assets Viacom had, what assets CBS had, who's going to be in leadership, that they both just needed to get bigger so that they could compete in this streaming war that we're all setting about. You know, over the past few years, we have seen AT&T buy Time Warner, or perhaps you could say Time Warner sell out to AT&T. We've seen Fox and the Murdochs sell a lot of their assets to Disney. And now most of the companies that are playing in media and entertainment are companies that are worth $100 billion, $200 billion. If you count companies like Apple and Amazon, $800 billion, $900 billion. CBS and Viacom are minnows compared to that. Even combined, they're worth only about $30 billion. But by coming together, they get to take a deep library of movies and TV shows and funnel those into streaming services that they're already selling, but will get much stronger with the deep library of shows.
So how does this position this now combined entity against all of the other newly merged, now larger media companies?
You know, it's still small in comparison. And most analysts that you speak to, most investors, believe that there are probably more deals to be made. I spoke with Bob Bakish earlier today. He's going to be the CEO of the combined company. He acknowledged that more M&A is likely. Now, it's not clear if that's going to make them a buyer or a seller. They could go out. They have been linked at various points to companies like Lionsgate and Discovery. And it's possible that they may try to buy one of them or merge with one of them. It's also possible that the Redstone family, which is going to control the combined company, will decide that now is the time to cash out. Now that you've taken a couple of assets that were seen as maybe a little weak, put them together, it's stronger, and it might be able to entice some larger company to come in and scoop it up.
That was Bloomberg's Lucas Shaw. As for details on the newly merged company's strategies and synergies, we heard this week from Viacom CEO Bob Bakish, who sat down with Bloomberg's Vonnie Quinn in New York.
We're thrilled that yesterday we announced the combination of Viacom, CBS, creating a leading global multi-platform premium content company. When you look at the assets, it unites, the powerhouse CBS, a broadcaster, a station operator, a syndicator, a studio, with Paramount Pictures, one of the most storied studios in Hollywood, a set of global brands in Nickelodeon and MTV and Comedy Central and BET that have really shaped culture for 40 years. Simon & Schuster, a force in consumer publishing, and of course Showtime, a premium service that's really pushed the boundaries of storytelling. So we've created an incredible asset base. Now this was a deal that was negotiated by 2 special committees that went through a very diligent and thoughtful process. And again, I think the critical thing is we got the deal done because it positions us to do great things going forward.
No question it's a phenomenal deal for both sides, and clearly there was willingness on both sides to get it done somehow. Yet there are some shareholders that are a little bit nonplussed that Viacom isn't valued more in this deal. Mario Gabelli, for example, threatening to sue. Could you have come up? Would CBS have given in eventually?
Again, this is a deal. The negotiation was conducted by 2 special committees of independent directors. What you need to focus on is the value creation potential that's here. These are 2 companies that are valued at particularly low multiples. A lot of that was due to the uncertainty that was hanging over them, including this deal, and also a lack of clarity on the path forward. Starting yesterday, we started talking about a 3-part growth strategy. Really building a significant D2C business through the combination of CBS's subscription start, where they have millions of subscribers between CBS All Access and Showtime OTT, and Viacom's ad-supported structure, with Pluto TV being the leading free streaming TV service in the U.S. 18 million monthly active users, up 50% since we bought it. You put those together, you got a D2C ecosystem. We love that. We will be a very significant B2B partner with ad and distributors, and of course, a huge content supplier. So very exciting growth strategy going forward. As that tracks out, people will see the very material value that's here.
You've also identified $500 million in cost savings. Some of those will be job eliminations. Can you give us any more detail on how many, perhaps, and where?
Sure. Well, look, when you put 2 companies together, people talk about synergies. Those synergies, in our case, the number you reference is a cost number. It's a gross cost number. It includes some organizational costs, some sourcing benefits, and some real estate benefits. Beyond that, we haven't gotten into it. But I think the more important thing to focus on is the power of this combination is going to create incredible value for all of our stakeholders, including the incredible employees of Viacom CBS, who together are going to shape the future of media. And I think that's what people need to focus on.
Viacom CEO Bob Bakish there. Coming up, SoftBank's Massive Vision Fund makes its first ever energy storage bet. We'll find out what Energy Vault is with its CEO next. This is Bloomberg. SoftBank's Massive Vision Fund made its first ever energy storage bet Wednesday. The fund will invest $110 million in Energy Vault. The Swiss company system uses cranes to stack concrete blocks in a tower that can store and release energy. It is presenting the system as a bigger and more affordable solution to lithium batteries, claiming it can supply electricity to the grid 24 hours a day. To discuss what this means for the energy storage market, I sat down with Energy Vault CEO Robert Picconi.
We've designed a very innovative new system tower. It includes a 6-arm crane, newly designed. It includes 35,000 metric ton bricks that are all orchestrated and raised and lowered with a proprietary software stack. So that's the whole system integration. What we do is we take excess energy from solar or wind when it's produced and it's not needed. That energy is used to raise the blocks, and then when the energy is needed by the grid, we lower those blocks and discharge the energy.
And how widely deployed is it? You've said you're on 4 continents.
Yeah, correct. So we've had already a working model for the last year in Switzerland. We already announced Tata Power as a customer. In addition, we're building our first commercial scale unit in the 4th quarter in the north of Italy. And as we announced, many customer engagements on many continents, so very excited.
So what do you think the draw is for SoftBank?
I think, well, first and foremost, they share our vision for renewables, and they uniquely understand how important energy storage is to make renewables real and make renewables solve the problem of our reliance on fossil fuel. They own an energy company, so they own an energy generation company. So they've understood this beyond just being an investor. They clearly understand it. They share our passion to solve this problem.
So the system, as I understand it, and we saw there, relies on this giant automated system that has to work reliably outside in the elements year after year after year. It seems like a lot of moving parts. Do you have concerns, or is there a risk that some part could not function properly given all of that exposure and throw the whole thing off.
Actually, that's one of the beauties of the innovation. The technology that we're leveraging fundamentally is proven physics. So tower cranes, we're leveraging some unique material science, working with Cemex, one of the largest materials company in the world. So we actually aren't using normal concrete. So we're using a material composite for 95% of these bricks and raising and lowering them. So the fundamental core physics is known. Where our innovation comes in is with the proprietary machine vision software that fully automates the tower. As well as a lot of other innovation we've thought of from a sustainability perspective. And this last point is very important. So not only the materials we can use the soil right from the site that we excavate, for example, locally to make these bricks. So we don't have to bring in trucks to bring in material. So we aren't spewing emissions with trucks coming in or other transportation elements coming in. And from a sustainable perspective, we use some of the suppliers in a global supply chain ecosystem that exists today, so we can do it now.
Now, we've seen lithium-ion batteries start to be attached to the energy grid, but often they can only supply energy for hours at a time. How long can your system?
Sure, that's another one of the innovations here is long duration. So while we can support 2 to 4 hour storage, we can do 8 to 12 hours of storage. And why is that important? We can not only meet the time shifting requirement of utilities, for example, to serve the early evening when the demand spikes, but think about manufacturing companies, industries that today, industrial processes that rely on the power 24 hours a day. Desalination plants are a great example. They need that power to make drinking water 24 hours a day, and we can now provide them for the first time that power.
Now, we've seen a lot of pushback from local communities against, giant solar power plants, large wind farms, because of the fact that they don't look attractive. I mean, do you run the risk of that as well? I mean, a large concrete tower, while it might work, it might not be the most attractive thing somebody wants in their backyard.
Sure. Actually, for most of the markets where we're going to be building this system, it's out where there are solar farms, so out in typically more remote areas. Wind farms, so where wind farms are already built, there's already turbines sitting up high, and also the off-grid applications, which are pretty important for us to actually get power to remote farms, villages, et cetera, to areas that need power that can't get it from the grid. So in those locations, we don't see a lot of problems with the height.
So there's not really another company that does this way. What do you think is the most challenging or biggest, what other company is working on this in a different way that might be the most sort of challenging idea?
Sure. Actually,
what you've proposed here.
Yeah, the big thing we've really solved here, which has not been solved until now, are for the economics. So how do you get renewable energy storage down to a price when combined with solar or wind low cost? You can do it below the cost of fossil fuel. So that's really the major innovation, and we've done that through the material science, we've done that through thinking about the design, and we've done that through the sustainability. So that's really, I think, primarily what we're solving here that no one has been able to solve.
But you've got other sort of competing, crazy, bold ideas, pumping compressed air underground, releasing it through turbines. There are obviously a lot of different paths here to get to the best results and create the most amount of energy at the cheapest price. I mean, what do you think makes this better than all of those other ideas?
Yeah, sure. I think 3 main reasons. One is, when we designed this, Emily, we didn't want to have the dependency on things like geology or geography or topology. Dams, for example, pumped hydro relying on mountains and things. So we wanted to be able to deliver this everywhere. It's so big, the problem we're solving. Secondly, sustainability. So chemical battery companies, for example, have a lot of issues both in how they get that material, how they dispose of it. The batteries degrade immediately when you install them. So through cycling, they're going to degrade. Our system doesn't degrade at all over time. So you really have to solve this with innovation across material science, across design, and thinking always about sustainability of your environmental aspect every day.
Energy Vault CEO Robert Piccone there. Coming up, the antitrust cloud continues to swirl over big tech. We're going to take a deep dive into the FTC probe into Facebook next. And Bloomberg Tech live streaming on Twitter. You can find us there at Technology. Be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg. Welcome back back to the best of Bloomberg Technology. I'm Emily Chang. Now to a story we continue to follow. Washington targeting big tech on antitrust. The chair of the U.S. Federal Trade Commission is weighing in. In an interview with Bloomberg, Joe Simon said his agency is ready to get down and dirty if necessary. If you have to, you do it. It's not ideal because it's very messy, but if you have to, you have to. Remember that the FTC is currently investigating Facebook, including its acquisitions in an antitrust probe. That is just one of the big tech companies being targeted by the Trump administration. To discuss in Washington, Charlotte Slayman, Policy Counsel for Public Knowledge, joined us. Before that, she was part of the FTC's Anti-Competitive Practices Division. In New York, we had Sally Hubbard, Director of Enforcement Policy at the Open Markets Institute. Before that, she served as an Assistant Attorney General in the Antitrust Bureau of New York State, as well as Bloomberg Tech's Sarah Fryer.
It's hard to read much into it. If you have to, you have to. That's almost a tautology. But I think maybe what he's talking about is that it can be difficult to force significant divestiture, something that we would call a breakup. And in order to get that type of remedy at court, you need to show that it's really necessary. So again, sort of a tautological comment, but I think maybe that's what he means there.
Sally, would you agree? I mean, there's certainly been a lot of question given that the FTC recently fined Facebook $5 billion for privacy violation, but critics said it wasn't, that fine didn't go far enough. Do you agree that he has what it takes, or the agency has what it takes to make that leap if they have to?
I think he was just really stating the fact that that is a remedy that every antitrust enforcer needs to consider. I wouldn't really expect it out of Joe Simons, given how he handled the Facebook consent decree violations and really just gave them a slap on the wrist. I know a $5 billion fine sounds like a lot, but it's really not going to change anything or protect the American people from privacy abuses. So I don't expect to see anything aggressive coming out of this administration. However, these cases and these investigations take a long time. So it may not be Joe Simons who's ultimately the one making the decision about what the proper remedy is, whether it should be broken up or a different type of conduct.
Meantime, Sarah, you've got a new piece out in Bloomberg Business Week that speaks to how Facebook has evolved under scrutiny from regulators after this fine, this penalty was levied by the FTC. And your assessment is Facebook's only getting stronger. How so?
If you think about it logically, the data is the most important part of Facebook's business model. That is what is at the bedrock of the $70 billion advertising business this year. And the FTC is basically telling Facebook, now it's very important that you don't share your most valuable asset with any third parties. And Facebook had already buttoned it up. They already don't want to share their data with third parties anymore. They understand that owning the network and owning a much bigger network and making that network bigger is the most important thing for the future of their business. So really what the FTC did is let the company continue on its current path and have an excuse to do things that are anti-competitive, like combine its messaging apps.
So, Charlotte, talk to us about, well, first of all, would you agree with Sarah's assessment there?
Yes, I think that's a major concern. Something that I was hoping that the FTC might do in this settlement would be have some requirements for interoperability with competitors. That is a form of data sharing, but it allows competition, so I think it's really important.
So, Sally, at what point do you think the FTC would say, okay, this is a company that needs to be broken up? Whether it's Facebook or Joe Simon specifically spoke to Amazon in particular and the issue around third-party sellers.
Yeah, so, it takes years of investigation before an enforcer is going to break up a company. In our history, when it's been done, it's taken time. I think, like I said, it may very well be after the 2020 election, and we could have even a different decision maker making the ultimate decision. And the concerns that he voiced about Amazon, I think, are also very important. That it's not allowed to enforce basically rules that it said it wasn't going to do in terms of low pricing on its third-party sellers in a different way.
Charlotte, as somebody who worked at the FTC, how concerning is the Amazon issue in your mind?
Well, the FTC certainly wants to make sure that competition is happening fairly on the Amazon platform. So small retailers ought to be able to compete and not worry that Amazon is going to anti-competitively interfere with them. So I think that's the kind of thing that the FTC is going to be looking for.
Now, Sarah, in response to the FTC penalty on Facebook, Alex Stamos, the former chief security officer at Facebook, had a pretty striking tweet. He said, "I can't believe Facebook didn't pay more for this. If the FTC offered to order Amazon to help consumers save money by offering house-branded options in every top category, Bezos would leap across the table with a $10 billion check and a massive grin." What does he mean by that?
He means that basically this is a valuable asset that Facebook is no longer allowed to share. Therefore, it's good for Facebook to have this rule in place. The Facebook of 5 or 7 years ago, the one that resulted in Cambridge Analytica, that's no longer how Facebook works today. There aren't developers making personality quizzes or games that operate on Facebook anymore. That used to be necessary in order to bring in more users. But in this current world, Facebook no longer wants that. And in fact, it wants to keep its entire network that it's built mostly for itself.
Now, it's interesting, Sarah, you just came out with a fascinating piece yesterday about how Facebook contractors are listening to audio of its users talking over Facebook Messenger, and yet, today the story about Facebook only getting stronger. Sally, I'm wondering, why don't these bad news stories seem to hurt Facebook more than they do?
I mean, I think the reason why the bad news stories don't hurt Facebook is because the enforcers aren't making Facebook change its business practices. So when it got the fine, and the fine was just a fraction of its annual revenue, and it was able to still keep doing what it's been doing, mining users' data in a way that they don't expect, and that's how it makes its billions of dollars. So that's why, that settlement was a win for Facebook. Until an enforcer makes them actually change their business practices in a way that affects profitability, their stocks are not going to be affected.
So, Charlotte, what is your expectation of how this FTC investigation, antitrust investigation of Facebook will play out, as well as a potential investigation into Amazon?
So, of course, it's hard to predict. We don't have access to the non-public documents that they are reviewing at the FTC. But I do think we should not expect that it's going to lead to huge changes. As Sally mentioned, the track record here is not strong on that. And antitrust is a actually very narrow and difficult area of the law. So actually, our hope is that there will be a new agency with new regulatory powers in addition to antitrust. And I think that's how we're really going to address the power that Facebook has.
That was Sally Hubbard of the Open Markets Institute, Charlotte Slayman of Public Knowledge, and our own Sarah Fryer. Coming up, Tencent posted earnings this week, revenue falling short amid the Chinese economic slowdown, but Alibaba proving it has room to run, reporting better than expected results. We'll break down both companies next. This is Bloomberg. Tencent reported second quarter revenue Wednesday that missed analyst estimates, while the Chinese social media and gaming giant beat profit expectations. Online ad revenue grew a worse than expected 16%. This as it grapples with increasing competition from rival ByteDance and a broader economic slowdown. For more on Tencent, I spoke with Bloomberg's Selena Wang in Beijing.
Even though those profit numbers beat expectations, the focus was really on that decline in growth around the online ad revenue. Now, even though this isn't the most important section of Tencent, it was a very promising area. We're really starting to see it get hit by some of these broader macroeconomic issues in China, as well as competition from the likes of ByteDance. What was interesting on the call was where the company pointed out the slowdown in advertising ad sales buying. So this is from the auto sector, the real estate sector, the financial sector. which is really not a surprise given the string of weak economic data that we've seen come out of China. Now, in terms of ByteDance, this is the big elephant in the room. That company has just been on a roll in terms of getting big companies to buy into their ads, as well as buying user eyeballs onto their platform. And the company didn't directly mention that company by name, but it did say that it would be investing more in mini video apps, short video apps, which ByteDance is a leader in, but it would also be beefing up its long-form quality content to try to differentiate itself from its competitors.
Now, gaming has been a controversial part of the business in China. Of course, the Chinese government has cracked down on the gaming industry. That has since eased up. But what did we learn about the gaming segment at Tencent today?
For Tencent, the worst is over in terms of the gaming sector, which is important given that this is still the company's most important revenue line. Now, we did see them start to monetize on some of their very important games, the new game including Peacemaker Elite. Now, for those who didn't know, this is the new, less toned down, less violent version of the very popular Battle Royale game that didn't get approval from Chinese regulators. Now, we didn't see the full growth from those game title monetization, but analysts are expecting that to pick up in the later part of the year. You mentioned censorship. For any company in China in the gaming, content, entertainment, media space, they have to deal with government censors, and those regulators haven't been approving these game titles fast enough. And we also heard from CEO Pony Ma that they're going to be focused on making less violent games. They're going to be trying to manage the time and keeping a more balanced profile of these games, especially when it comes to teenagers. And on that censorship front, the ad sales around media ad sales were also hurt significantly by censorship. And the expectation is that this is because of, as we're waiting for China's big national day later in this year, they're slowing down and being more strict and cracking down in terms of what content can be shown.
Meantime, WeChat, of course, is the crown jewel of Tencent, sort of a super app to which there's no real equivalent here in the United States. How is WeChat doing?
In China, we certainly rely on WeChat for everything, whether it's communication or booking ride-hailing or haircuts, or pretty much you can do anything in it. And what's shocking is that this WeChat app is definitely reaching penetration, but it's still growing. It actually grew 7% to 1.1 billion users in this most recent quarter. Now, to try and continue to juice growth there, they're trying to add more services, more content into the app. They're also really focusing a lot of energy on these mini apps, which are essentially light apps within the app that encourages users to spend more time within WeChat rather than other parts of the internet. And we've seen companies respond really positively to those mini apps, and it can be used for anything from booking a car to ride hailing, as well as bike sharing. So that's been a really successful area of growth within WeChat.
Bloomberg's Selena Wang there. This week, Selena was also tracking Alibaba results out Thursday. The e-commerce retailer defied China's slowdown, its sales beating top estimates. Selena and Kevin Carter of EMQQ discussed the company that made founder Jack Ma a household name.
In spite of the trade wars, in spite of the tariff talks, the real story in China and emerging markets is the billions of consumers that are moving on up, and they want stuff. More and better food, more and better clothing, appliances, etc. And that's been the story, that remains the story. Even as growth has slowed in China, retail sales and consumption continues. And in emerging markets, that consumption is going online, onto a smartphone, just as it is here. But there's a leapfrogging going on because most of the traditional consumption infrastructure was never developed in China.
Selena, Alibaba co-founder Joe Tsai talked about demographics and digitization, that was what was driving these results despite what was happening macroeconomically and geopolitically. But I guess the question is, how long can that keep up?
Joseph Tsai pointed out a few factors that are really driving the growth, and you're right. The question is, how long can this support Alibaba's earning amid this broader macroeconomic slowdown and this trade war that looks like it has no end? One of them is the consumer upgrade in the developed markets. So Joseph Tsai mentioned that the developed markets, the tier 1 cities, are reaching the levels of consumptions of developed markets around the world. Now, in addition to that, their push in these lower tier cities are also starting to pay off. You're seeing rapid digitization as well as sales, urbanization in these lower tier cities, and it's showing that they're really able to go head to head with competition with companies like PDD that are focused specifically on these lower tier markets. And they say that they are planning to invest more in these areas, that their market share is in fact growing as well. So this is a really big trend in China that seems to be defying the broader slowdown. But in addition to that, they're also investing a lot in personalization, in targeting these types of consumers better with better algorithms, as well as investing in sales promotion. So that all together is helping to boost that China commerce business by 40%, almost twice the amount of online retail sales in China.
So, Kevin, would this lead you to believe that e-commerce in general as a segment will not be impacted by trade tensions in China?
I think it's probably the sector to be affected the least.
Why?
I mean, because the tariffs and the trade war is about agricultural products on our side, manufactured goods, and EMQQ and e-commerce. It's about the 500 million people in China that still don't have a smartphone, that are going to get a smartphone. They're going to be in the third or fourth tier city, and as soon as they get that, they're going to connect with their friends, they're going to play games, they're going to shop. So the secular trend of e-commerce is a one-directional thing, and it's not really part of the trade war.
And, to that point, Selena, JD.com also reported results earlier this week, strong results that said Alibaba does have increasing competition from not just JD, but Pinduoduo. What are the headwinds that Alibaba faces ahead?
Alibaba has been pretty resilient amid increasing competition from the likes of JD.com as well as from Pinduoduo in those lower tier cities. But we did see some areas of challenges. That cloud computing segment still has those negative operating margins. We also saw growth start to decelerate in that area. There's also losses at the digital and media entertainment sector that has narrowed, but they are facing increasing regulatory issues. Something that's worth pointing out is that Alibaba is actually it's based off of advertising. It's not truly an e-commerce company in the way that you would think of Amazon as an e-commerce company. And while we saw Tencent's online advertising really take a hit, Alibaba's business has maintained strength there. So they are doing things to keep their customers engaged and improve the advertising return on investment for their customers.
So, Kevin, if the trade war drags on, and it appears that it is going to drag on, we don't know how long, what do you think the fallout is going to be in China more broadly as an emerging market?
Well, I think that it's likely to impact the Chinese economy. Mm-hmm. It's likely to impact the sectors that are part of the story, which are the export sector, the manufacturing sector. But I would like to think that the tariffs are not going to go into effect. I mean, mathematically...
Well, there are many tariffs that are already in effect.
This is true, and in both directions. But the new ones that have been proposed, the ones that were pushed out till December, I'd like to think this is just a negotiating tactic. I mean, the mathematics of tariffs is decidedly bad. We had a trade skirmish with China 10 years ago. Mm-hmm. We put a tariff on Chinese tires. They responded by putting a tariff on on our chicken feet. But that was a tariff put in under the Obama administration. It lived for 3 years, and they've been able to go back and study it, and it saved 1,200 American tire-making jobs at a cost of $1 million per job, and it also cost 3 jobs in retail for every job it saved. And the American taxpayer funded that. So I'd like to think the mathematics of this are clear enough that we won't really do the things we're threatening. But if we do, the market's, I guess, voting now that we're going to have likely a recession in our country. And I frankly think it could be bad if we go ahead with the tariffs as described.
So 15 seconds. So where does that mean you're placing your bets? Quickly.
EMQQ, the emerging market internet companies, are not really part of the trade war. Mm-hmm. This is about people all over the world consuming, wanting stuff, using their smartphones.
That was Kevin Carter of EMQQ in San Francisco and Bloomberg Technology, Selena Wang in Beijing. Coming up, you know him as the former head of Google China. Kai-Fu Lee is now at the helm of one of China's most prominent venture capital funds called Sinovation Ventures. An exclusive conversation with him next as he eyes an AI IPO valued at more than $1 billion. This is Bloomberg. The former former head of Google China is turning heads at the helm of one of China's most prominent funds, Sinovation Ventures. Since its founding, Kai-Fu Lee's firm has invested in more than 300 companies. Among them, one startup he hopes will be the fastest AI startup to hit $100 million in revenue. Lee spoke exclusively to Bloomberg Tech's Selena Wang, who asked about the long-term plan for capital raising.
We don't plan this ahead of time. I think based on the trajectory of innovation, I think today it's fair to say it's the fastest to $100 million revenue company in the world for AI.
Where are you now?
We're not quite there yet, but by the time we project we'll get there, which is not far from now. It'll be the fastest to reach $100 million in revenue. A lot of unicorns aren't even at $100 million revenue. And so I think it can get there pretty quickly. That is both the revenue, over 100 million, onwards towards 200 million. At that point, it should be well over a unicorn and can be listed publicly.
So what's your timeline for an IPO?
I think that would be close to the time. $100 to $200 million revenue at a price sales ratio of 10 or so, which values the company at $1 to $2 billion. So it would not be far from now. It would be less than 2 years from now.
And you wrote in your book that the era of technological discovery and AI is over, and now it's all about implementation. So how do you see this business continuing to evolve?
We're still at a very early stage in the commercialization. We're still at kind of the equivalent of early internet portals, back when everybody was using Yahoo and there wasn't even a Google yet, nor Amazon nor Facebook. So there's a lot of room to reap rewards.
Now we're seeing venture deals fall dramatically. The value of deals fell 77%. Do you think this is a long-term winter, or is it just a healthy short-term place to bring valuations back to healthy levels?
On the negative side, in an economy that is slowing down, everything slows down, including venture capital. What will happen is there will definitely be a shakeout. The top VCs will continue to thrive. I think many of the smaller first-time VCs that may have raised money using unconventional ways are going to get in trouble. So that's one part of it. But the positive side is if the economy is challenging and the valuations are down, it's a good chance for us to go shopping.
There are reports that some Chinese AI companies, including some that you're invested in, like Face++, could be added to that blacklist, which means they'd be cut off from U.S. technology. How do you see that playing out? And does it really have an impact on China's AI industry?
The AI companies are largely built on software stack that are domestically developed. So I think the impact would be much less than, say, on a company like Huawei, which has intricate hardware software products built with multiple dependencies.
The U.S. has been scrutinizing foreign deals in the U.S., and many Chinese funds have scaled back their investments, including Sinovation. How does this impact your strategy in the short term and in the long term? In the short term, it has no impact, because U.S. investment has always been less than 5% of our total. So now it just goes from 5% to 2%. So it's inconsequential. In the long term, I think it is a pity if we have to really cause a total separation of two countries, because one could argue that artificial intelligence got to where it got to because the whole world has been able to work together.
Part of our exclusive interview there with Kai-Fu Lee, Chair and CEO of Sinovation Ventures. And that does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. You can tune in every day, 5 p.m. in New York, 2 p.m. in San Francisco. And we are live streaming on Twitter as well. Find us there at Technology, and be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.